Welcome to the TAC Index AI Weekly Recap Podcast, where we blend TAC IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo. Today, we're embarking on what feels like a crucial mission to crack open the latest air freight data. We want to uncover the hidden forces really shaping global trade and travel. Is the world speeding up, slowing down, or maybe just taking a surprising detour?
That's exactly right. And for you listening in, this deep dive is essentially a shortcut. It's about understanding how seemingly isolated events, think major interest rate decisions, geopolitical tensions, are actually intricately linked to the very movement of goods and people around the globe. We'll connect these dots, especially within the dynamic world of air cargo, hopefully providing you with a clearer, more nuanced picture of this, complex interplay of forces.
All right, let's kick things off then, checking the pulse of global air cargo. We're looking at the recent TAC index data. This is for the week ending June 16th, 2025. The global Baltic air freight index, BAI00, it edged up just slightly, 0.4% week over week.
Just a tiny bit.
Exactly. But, and this is key, it's still sitting almost 6% lower year over year. What's really interesting, I think, is that after that 90-day U.S.-China tariff suspension deal, expectations were quite high, right, for an upward trend?
They were, yeah.
But that momentum seems to have just, petered out. What exactly happened there? Was the market just underwhelmed, or are there sort of deeper issues at play?
It's probably a bit of both, actually. The Take My Index report points to a couple of key things here. First, we saw the end of that de minimis exemption for small parcels coming into the U.S.
Ah, right. That's significant.
It is. That rule used to let a lot of low-value shipments bypass duties and get quicker entry. Removing it likely put a damper on some expected volume. And second, there's just this persistent uncertainty about the broader economic outlook. That makes businesses, consumers too, more cautious, and that directly hits demand for air freight.
Okay, let's unpack this a bit more then. With that context, where are we seeing the most significant movement? On specific lanes. Are there standout areas, or is it a fairly uniform picture across the board?
Well, it's far from uniform. That's what makes this market so dynamic, really.
Yeah.
The trends vary quite a bit. Let's zero in on Asia first. The picture there is largely one of decline. Major hubs like Hong Kong, Shanghai, they're seeing clear, sustained downward pressure on rates. For instance, Hong Kong outbound rates, that's our BAI 30 index, they dipped again. And crucially, the pure spot rates from Hong Kong, they were actually declining all week long. That reflects a pretty significant year-over-year drop.
Okay.
Shanghai's rates, BAI 80, also continued that downward trend. And even rates out of Vietnam, they were consistently lower to both Europe and the U.S. and, significantly down compared to last year.
So a pretty clear downward pull from those big Asian manufacturing and export centers. Are there any exceptions to that within Asia, or is it mostly heading down across the board?
There are actually a few notable bright spots, yeah. Rates from India, for example. They actually saw a slight increase week over week to both Europe and the U.S.
Oh, interesting.
Though, they still remain considerably lower year over year. But the main exceptions out of Asia, the ones holding strong, even seeing gains, are routes heading to Europe from Bangkok and Seoul.
Right.
Both of those lanes are actually still well up year over year. That's a significant counter trend compared to the rest of the region. It suggests maybe unique demand pockets or perhaps some supply chain shifts focusing on those areas.
Fascinating. Okay. What about Europe outbound? Are those lanes mirroring Asia's declines, or is there a different story playing out over there?
A distinctly different story in many ways. From Europe, overall rates were actually up week over week going to China.
Up to China, okay.
Yeah. Though they were down going to Japan and a little lower overall to the U.S. But, and this is a crucial point, transatlantic lanes from Europe are still well ahead year over year.
Right.
Frankfurt, our BAI 20 index, gained a healthy amount last week and narrowed its year over year deficit quite a bit. And London Heathrow, BAI 40, that really stands out.
I saw that number, yeah.
After some pretty sharp fluctuations recently, it enjoyed another very strong gain last week. A huge surge. This was driven mostly by substantial increases on rates heading to Southeast Asia, the Middle East, and also the U.S. It positions Heathrow very healthily up compared to last year. It's quite the jump.
London Heathrow is certainly breaking out there. And what about North America outbound? How are things looking from this side of the pond?
From North America, the picture's a bit mixed, but generally, I'd say more resilient. Overall rates were a little lower week over week to Europe and South America. Though still well up southbound year over year, it's worth noting.
Okay.
Interestingly, rates were actually up week over week going to China. And Chicago, that's BAI 50, It gained last week as well, leaving it just narrowly ahead year over year.
So not the broad declines we saw out of China.
Exactly. And just a broader note here, TTAC index keeps expanding its scope. They recently added new lanes connecting Europe to places like India, the UAE, Mexico, Brazil, Australia, South Africa, and also new routes from Mexico to Europe and from China to India, Spain, and Australia. It just signals, a continually evolving market and a growing need for that really granular data.
Right. The details matter more than ever.
Yeah.
Now, let's zoom out a bit. Let's connect these very specific air freight trends to the bigger macroeconomic picture, particularly what's been happening with the Federal Reserve. Here's where it gets really interesting for you, the listener.
Absolutely. They're deeply intertwined. You can't really look at one without the other. The Federal Reserve on June 18th, 2025, made that decision most people expected, holding interest rates steady, keeping them in that 4.25% to 4.5% range.
Right.
But crucially, they kept the door open for potential rate cuts later this year in the second half. That decision and all the signals around it, they directly influence global economic activity, which in turn impacts everything from manufacturing output to consumer demand, and both of those hit air cargo volumes directly.
And we even heard President Trump weighing in preemptively on this, didn't we, calling for much more dramatic rate cuts and being pretty critical of Fed Chair Jerome Powell. It really highlights the political pressure cooker the Fed is in.
Absolutely. And the Fed's position is, well, it's a delicate balancing act.
Yeah.
To restart those rate cuts they began last year, officials are looking for basically two main signals. Either they need to see a clear softening in the labor markets, or they need stronger evidence that price increases from these recent tariffs will be, relatively muted.
Okay.
The projections released after the meeting really highlight a growing divergence among Fed officials themselves. While a narrower majority still expects at least 2 cuts this year, a significant portion, 7 out of 19 officials, penciled in no changes at all for 2025. That's up from only 4 back in March.
So less consensus.
Exactly. And this creates a potentially tricky situation in their economic projections. They're now expecting both inflation and unemployment to rise more than they previously projected. This could force the Fed into a difficult choice. Do they cut rates to shore up the labor market or hold steady to defend against higher inflation? Fed Chair Powell himself even acknowledged the complexity. He said, quote, "We haven't been through a situation like this and think we have to be humble about our ability to forecast it."
Humility from the Fed. Imagine that. So what does this all mean for businesses and consumers then, especially with those big tariff announcements sort of hanging in the air? Given the Fed's caution, what's the most immediate risk? Is it higher prices we should brace for, or maybe something else entirely?
Those tariffs are a major wild card, definitely. And the Fed's caution stems directly from that uncertainty about their impact on inflation. President Trump's Liberation Day tariff announcements back on April 2nd, even with some big hikes suspended, have raised U.S. tariff rates to their highest levels since, the 1930s.
Quite something.
It is. So the Fed faces this classic dilemma. Cut rates too soon, and you risk reigniting inflation. Businesses might pass on higher import costs. Lower rates could fuel activity at the wrong moment. But wait too long, especially with rising tariff costs, squeezing companies, and you could hurt profits, potentially leading to layoffs, maybe even recession.
Tricky spot.
Very. Interestingly, though, despite all these expectations, the May inflation data actually came in surprisingly mild. So some analysts are now suggesting, well, maybe these tariffs are actually hurting business margins more than directly driving up consumer prices. Which, if that continues, could ultimately lead to higher unemployment down the line. And we can't forget other factors piling on. That ongoing conflict in the Middle East. It's threatening to reverse recent drops in energy prices. That layers yet another supply shock on top of the tariff shock, reinforcing the case for caution.
It almost seems contradictory, though, doesn't it? On one hand, we see labor market data showing some softness, like extended unemployment benefits near a 3-year high, downward revisions to job growth numbers.
Right.
Yet, on the other hand, financial conditions, things like corporate bond issuance, stock markets near all-time highs, they remain surprisingly buoyant. How do you explain that divergence? How does the Fed navigate that?
That's precisely the challenge, isn't it? Those buoyant financing conditions make it harder to justify cutting rates. The market seems to be signaling strength in a way. The central bank is very apprehensive, not just about how big any price increases might be, but also about how these high-profile tariff announcements could disrupt what economists call inflation expectations.
Right, the psychology.
Exactly. It's a crucial concept. If businesses and consumers expect prices to rise, they might start behaving in ways that make it happen, like businesses trying to pass on price increases, even if they aren't directly hit by tariffs. It becomes self-fulfilling. Powell noted after a generationally bad episode of inflation, there's a real concern that this lack of confidence makes the inflation process more fragile.
Okay, let's pivot now to something that might surprise you listening in. Transatlantic airfares. Passenger travel. We're seeing significant slump there, prices dropping back to pre-pandemic levels. What's driving this decline, especially when cargo's showing some volatility?
Yeah, this is a really interesting countercurrent, quite different from the cargo side we've been discussing. A Reuters report confirms it. Transatlantic airfares have indeed dropped back to pre-pandemic levels, and this trend looks set to continue, potentially right through the summer holiday period and maybe beyond. The primary reason cited for this drop in travel from Western Europe to the U.S., concerns about U.S. border controls, and again, the shadow of President Donald Trump's policies seems to be a factor. Plus, a stronger dollar makes trips to the U.S. more expensive for European travelers.
Makes sense.
We see specific examples, too. Travel from Western Europe fell over 4% in May. Denmark saw a 20% drop, Germany 19%. Germany even updated its travel advisory, specifically emphasizing that having a visa doesn't actually guarantee entry. That clearly causes some hesitancy.
Wow, 20% from Denmark. 19% from Germany. Those are huge drops. That must be having a real impact on the airlines, especially European carriers, after all the challenges they've already faced.
It is indeed adding financial pain, yeah. Particularly for carriers like Air France, KLM, and Lufthansa. They're already grappling with higher labor costs, higher oil prices, plus the ongoing disruption from the Middle East conflicts. That's forcing longer, more costly routes to and from Asia. So this just compounds their challenges on the transatlantic front. It's a tough environment for them caught between rising costs and softening demand on these key routes.
But it's not all doom and gloom across the board, is it? What about the other side of the Atlantic? Are Americans still keen on traveling to Europe, maybe offsetting some of that decline?
That's precisely the offsetting trend, and it seems to be quite a strong one. While European outbound travel to the U.S. is weaker, U.S. outbound travel to Europe is proving much more robust.
Okay, good news for someone.
Definitely. Both Lufthansa and United Airlines have noted significantly higher demand from U.S. travelers heading to Europe. United, for instance, they reported that while their international bookings from Europe fell 6% in Q1, U.S. originating demand more than made up for that pullback.
Right.
Delta Airlines made it something similar. A substantial 80% of its long-haul international demand actually originates from the U.S., and fares in that U.S. originating region are significantly higher than elsewhere.
Interesting.
So this strong demand from the U.S. side means airlines like Lufthansa are even planning to market more aggressively to Americans now. In fact, as of mid-May, there were over 4% more international flights scheduled to depart from U.S. airports this summer compared to last. So yeah, there's a definite asymmetry in transatlantic travel right now, with U.S. demand providing a crucial lifeline.
So pulling it all together, what does this all mean for you, our listener? We've talked about global air freight rates kind of inching up slightly, but still below last year. Overall, the Fed playing it cautious on interest rates, the complex impact of tariffs, and even these shifts in transatlantic passenger travel. It really paints a picture of a global economy in, well, flux, doesn't it? Almost like trying to solve a puzzle where the pieces keep moving.
It absolutely does. And what's fascinating here is seeing how these seemingly separate data points are all interconnected. A fractional rise in global cargo rates on some lanes may be a dip on others. A Federal Reserve hesitant to cut rates because of tariff uncertainty. A big shift in leisure travel patterns between continents. They're not isolated incidents. They're ripples. Ripples from broader geopolitical decisions like tariffs, like the Middle East conflict, from the nuances of monetary policy, and from shifts in consumer behavior. All these forces just cascade through the entire logistics chain, influencing macro markets and ultimately affecting things like global supply chains, consumer prices. It really emphasizes how the air cargo market, even while experiencing its own specific regional trends like we detailed, is highly sensitive to these bigger economic and political winds. It means what happens in a central bank meeting room or in a geopolitical hotspot far away can directly influence the speed and cost of getting goods to market, affecting businesses and ultimately affecting you.
And given the Fed's own admission about how unpredictable things are, Powell's humility, and this complex dance between global trade, inflation, even traveler sentiment, what does it mean for how we perceive market stability? It feels like predictability is becoming increasingly rare.
Well, in a world where economic projections are, as you said, humble, and where those inflation expectations seem so fragile, it really raises an important question for you to consider. What surprising, perhaps unexpected ripple effect might we see next? something that stems directly from these air freight lanes or these global travel patterns we've discussed today. How might these small shifts in air currents, hint at larger economic storms or maybe even calm waters just over the horizon?
A fascinating question to ponder. Thank you for joining us on this deep dive into the latest in air cargo, logistics, and the broader macro market. We really hope this exploration has given you a clearer, maybe more nuanced understanding of the forces at play right now. We encourage you to keep exploring the fascinating interconnections between all these topics and, of course, stay informed. Until next time,